So I'll take a local flavor, and I would invest it in the 60 to 80% LTV space in German hidden champions in cities where the global money never finds its way, but you have a lot of stable property and cash flows, and you have very low risk and an exaggerated return that you can ask because nobody else provides for the 60 to 80 LTV space.
Good, very precise. Paul?
I think it depends on what you want as far as your relative value. So if you're a normal fixed income investor, then that's investing in bonds, then actually real estate debt makes a lot of sense, and senior real estate debt is good relative value. But if you're a normal real estate investor that maybe doesn't want to take the downside because they don't know where values are going to go, then real estate mezzanine actually makes a lot of sense. So it really depends on your return requirements and where your relative value is.
Okay, my return requirements are extraordinarily high. I've got all this staff to keep busy for, Exactly. Morten?
I think what we are seeing right now, which we think is particularly interesting, is focusing from an asset class perspective is residential. We're seeing residential in the metropolitan cities. We are seeing urbanization trend going on, and no development financing. So it means that there's a lack of supply, but there's huge demand. So from an asset side perspective, residentials in the Nordic capitals, for instance, Copenhagen.
Okay, all right, interesting. Michael, you've got a slightly more challenging view. You can either decide that it's where would you lend. You can decide. I'll leave that with you.
Make it very efficient. Where would I not do this? No, but taking this while I will not come with a big elaborated expertise here, I would see also residential, especially in some German large cities where still some catch up. I think also there has been some price increase, but it will certainly continue to some extent. I would also bet on some stars of the, let's say, last year's, which will be shiny again. I would say, well, Ireland, Spain, certainly. Not Italy, not Greece. Some of the US markets where we see also a very high trend to residential. When you go to San Francisco or Los Angeles, you see people on bicycles, you see small cars. In Los Angeles, mostly electric. So there's a trend to urbanization over there that is very interesting to watch and to invest in. And still some potential I would see in Eastern Europe and say beyond Poland, Baltics, maybe Romania a little bit. Yeah, that's about it.
Okay, good. Anthony, you've raised all this money, so you can tell us how you are going to invest it.
Being the last one on the chain, as it were, all I could really probably say is just yes, but no, I won't do that. Realistically, what I would say, the type of money I'm playing with looks for an element of growth in their return. So if you focus on markets, for example, central London, where we are already very, very fully priced, question is, how much growth can you expect to come through? How much stability will there be in the longer term? So I'm very cautious about markets where we have seen significant positive price excursions over the last 1 to 2 years. So I'm looking very much outside of central London. That for me is regions. I'm very happy looking at some development work. I'm very happy looking at all types of refurbishment and forward funding. So I'm going very contra-cyclical in some people's minds and saying I'm a risk taker, but my process of underwriting that risk is embedded, and I really do mean the word embedded, in the real estate function, because every single transaction that we will look at has to be underwritten by the real estate team as if it was an equity transaction first. And that makes us comfortable taking more risk than perhaps other people would normally expect to take.
Great, thank you very much. Thank you very much for coming, and thank you very much to the panel for a very interesting discussion. Thank you.